Madhu, I just want to bring your perspective on where you see India. I mean, how long before we see the time correction ending and some significant up move actually kicking in?
See, I say let's divide it into two parts. What is the economy doing and what the markets are doing, basically. And over a period of time, if the economy does well, clearly it will get reflected in the markets. So I see two pockets of the markets. First, talking about the markets. A is clearly, good quality promoter, very good respected companies, very good businesses. But there I see valuations are also rich. So there is a clear-cut bull market which is going on. So we did some exercise in terms of if we had to take a derived Nifty of these stocks, which is auto, FMCG. So the Nifty is clearly trading somewhere like 7,000 to 8,000. If I took them as a base, and if I took a derived Nifty for the stocks which have not done well, let's say something like real estate, infrastructure, then Nifty is trading anywhere between 2,200 to 2,600. So this is a very wide gap and a polarized performance of stocks in a lot of pockets. Where I see clearly opportunity for an investor over the next 3-5 year time frame. See, as we have been telling in bull market, equity returns over a period of time in a long term average out what the ROEs are or what the earning growth is. So in India's case, over a longer period of time, it has averaged out between 15 and 17%, even if you take like last 20-year equity return of Sensex. So I am seeing a lot of pockets where now equity returns have become negative. Wherein last 5-year equity return is negative, last 3-year equity return is negative, last 1-year equity return is negative, in some cases last 7-year equity return is negative. So in another interview I said that the market is divided in touch me and touch me not. So this is a pocket which is like touch me not today. But this is where, in my experience of last 20 years, you will have opportunities. There are a lot of promoters who went on with gung-ho attitude. They also participated in the bull market. But at some point of time, they realized, no, it is not about market cap. Let us look back into business. Let us focus on cash flows. Let us make sure that we repair the balance sheets. And out of these 100, 200 companies which have been huge performers, I do not think it is very difficult to come out with 5, 10 names, which I think will give you disproportionate return as compared with the market or with the broader indices. Now, in early days, like what is happening today, there is virtually no confidence in these names. While you can see some of these companies' fundamental improving, and they have been improving over quarters. You can see last 4 quarters being good. You can see the management talking the right language, but it is not really reflected in the market. So I would say real bet is on those companies. Let's take another fact, like public sector bank. Now today, the whole world believes that entire India corporate sector is going to become NPL. Now a lot of these companies, a lot of these banks have started trade at 0.6, 0.7 time book value for 2012-13. I think some of this is exaggerated. And with my view of interest rate peaking out and inflation peaking out, I think some of these pockets will do very well.
Which businesses to your mind currently are experiencing a cyclical slowdown, and which businesses to your mind are experiencing a structural slowdown?
Nikun, there is a clear-cut, worry which I have in mind, which is relating to capital expenditure. Because, you look at the sentiment. When I go and meet industry people across the board, they are nervous. They are nervous, and there are good reason to be nervous. Demand is virtually slowing down. Policy making, there is a lacuna which has happened over the last 12-18 months, and over and above, most importantly, that you are not able to raise equity, you are not able to raise cheap debt. So when do you get confidence to invest money? So I think this is going to be a huge challenge for 12-13 and even part of 13-14. So unless we have dramatic reduction in interest rates, so a lot of these companies which are having huge capex, and unfortunate part of our reality is, we did again a correlation of last 5 to 10 years. Last 5 years, actually capex growth is as high as 35% between 2006 and 2007. But last 2 years is already slowing down.
So it's too early to buy the L&Ts and the BHLs of the world.
I would not get into specific names, Nikunj, but it may be possible that you need not buy L&T and BHL, but you may buy Jayaprakash. Now I'm just, for the purpose. So I am saying that out of those 20, 30, 40 names, now you have to really see which is the one which has corrected, where you see decisive improvement in a management's commitment to improve the balance sheet, improve P&L, focus on ROE, focus on businesses, and forget market cap, it will happen.
Right. Madhu, for someone who has identified multi-baggers in the past, names like JSPL, Siemens, BEML stocks, they have multiplied 10 times, 50 times, even 100 times in last 1 year. Which sector will throw up the next set of bears?
As I said, Nikunj, to my mind, these are clearly the underperformers, which is where I am focusing on. And you will get those underperformers, maybe in financial services also, maybe in some infrastructure names also, maybe something to do with cement also. Because you see, again, as I was saying, I re-emphasize that point, that equity returns over a period of time will average out if the businesses are doing well. So if you have, again, let's talk a specific company, Jayaprakash. And mind you, I'm not recommending this. But if you look at Jayaprakash...
But you've analyzed it well.
Yeah, I've analyzed it well. And we have a very large holding in all our institutions, so I have no hesitation talking about it. If you look at Jayaprakash, last 5 years, the company has grown very well, for between 2006 and 2011, while equity return is negative. So basically, but the debt which they have taken, are they generating higher ROEs as compared with the cost of debt? And when does the cost of debt beat the ROE? That is when these equity returns may start to kick in. So you will have selective examples like this in all this underperformer pack. And I'm sure investors who have, let's say, 3 to 5 year horizons will make money in some of these names.
So what would it take for us to snap out of the range, 4,800 to 5,200? Would it be the same set of touch me's, or would it be the touch me not who will come and perform?
I'm afraid, I don't think this range, the time is the only solution to this range, and I think market will spend some time before it really breaks out of that range. So basically, 6 months down the line, we may be again talking of 2013 earnings. 9 months down the line, 12 months down the line, we may start to talk of 2014 earnings. And market maybe at that point of time, that is the time when it will. Second, you have to look at indication what is happening really on the policy front. And in the, let's say, 12-18 months, that is where I have slight optimism vis-a-vis the market. Let's look at the facts. You have 12 state elections coming. You have general election coming. You have a 12th plan which is starting up. I am sure, there is something which will be done. And India's history is, I've been around for 20 years. Whenever we are pushed to the wall, there is someone who will act. Today it is very difficult to see who will act, how will he act. But there is someone who will act. In 1991, when we sold off our gold, someone acted, some policy, some liberalization happened. So I am quite optimistic that, given the next 24-month event, you will have a meaningful policy push over the next 3 to 6 months. Now, that push will not get reflected in the immediate term, because what had happened in the last 12-18 months, that has to get first sink in. The high cost of money and the lower demand and these worries actually has not got transmitted in corporate earnings. So I think that over the next 2 quarters, you may see that getting transmitted in corporate earnings and market consolidating. And then I think clearly this touch-me-nots should logically...
So is it too soon to start constructing a portfolio, or do you think the market is going to give you better levels to get?
No, I think it's a fantastic time to start constructing a portfolio, because even my grandfather has not seen what the bottom of the market is, and I don't preach to say that, this is the bottom or this is the top. You have to only be able to identify risk-reward. Do I see a risk-reward in some of these names? Yes. But am I really excited, as I have been, about India in the past, that you thumb the table, go buy 100%? I don't get that confidence, because where the globe is, where India's problems are. So be selective, be focused, know your stocks really well, and maybe accumulate over a period of time. Every time there is an issue in some Italy, some Greece, some part of the world, some American problem, yes, that is an opportunity to buy stocks which you like, which may be off that day by 5%, 10%, that is the time.
So Madhu, if you have to construct a portfolio for next 5 years, which are the asset classes that portfolio will contain? How much in equities, how much in bond, how much in gold, and how much in Reliance equity fund?
So I think, again, for a equity investor, I think by and large, if you do not have expertise and if you're not tracking the market, equity mutual funds are proven to be a decent vehicle. Now, equity mutual fund, debt mutual fund, balances, that is your call. So I think you must just, if you are a retail investor who is not really tracking the market, who has burned his fingers, then don't blame the market that, I bought this and it became this. You bought it wrong, you didn't know about it, so obviously it will become bad. So I would argue for a retail investor, mutual funds are still very, very good vehicle. And they have compounded retail investors' money by over 20% in the last 10-year time frame. I think that's a fantastic return, Nikunj. Between 18 to 20% given where the markets have been. So equity mutual fund should fall. I think gold should be a portion in the portfolio, though I'm not as exuberant on gold as I have been in the past given the rise of the gold, but I would not take it out. I would not take out silver from my portfolio, but I not speculate. I'll not buy gold and silver from a 3-month perspective, which is what is happening, and clearly keep some money in the fixed income, maybe in the income funds, wherein if the interest rate falls, clearly bond prices, it will get reflected into returns.
So Madhu, I don't want to get this one wrong, and for those who are watching the channel, for those who follow you, is it time to break their fixed deposits and invest in equity, or you're not that convinced?
I'm saying, Nikunj, it's all about portfolio allocation. If you have 100% of your money into fixed deposit, then it is time to break part of it and invest into equity markets. But if you are already invested 60% in equity markets, then maybe it is not the wisest of the thing to go and do I will just, because XYZ stock is available very cheap, I'll break everything and put all my money in equities. That is not what we are saying. And again, our experience with a lot of distributors and our investors who have done really well, finally the big call is only about asset allocation, Nikunj. If you are not in equity in the last 12 months or 24 months, and if you are significantly overweight on gold or fixed income, you have done really well. But if you again, this is not the time to be shying away from equity in that manner. That you cannot, just because you see negative sentiment about India, just because you see negative sentiment in the world, it is not just time to throw away equities.
So what are the themes and the sectors that are interesting you at these levels?
Again, I said, market is divided broadly into two parts, underperformer and significant outperformers. My choices, my overweight will come out of underperformers, which have really underperformed over 5 years, and I will choose companies which are reasonably valued. Again, when you are constructing a portfolio, you just can't go and buy all underperformers and all dogs. When you are constructing a portfolio, you are still getting some reasonable companies, at 13, 14, 15 times P multiple, even in that outperformer bracket.
And JP Associates could be one of them.
Yeah, it could be one of them. Clearly, it could be one of them.
Are you liking your new role now? You're no longer the captain of the investment team, you're the coach of the investment team?
Yeah, I'm really enjoying it, Nikunj, because I think what I missed in 10 years of my career, which is really focusing on some of this macro stuff, where I used to believe 5-10 years ago, inflation has no role to play in equity markets. It's all about bottom-up investing, and you find a good company, and you're done. Some of those beliefs I'm challenging myself, basically, because it is about macro factors. It is about how does the P multiple of a stock come from 16 to 8 to 8 and it becomes 8 to 4. These macro factors guide you towards it. Yep. And I'm working very, very hard to catch up to that stage.
You have two lovely daughters, Mai and Mika. One is 8, the other one is 4. So on the 18th birthday, which are the stocks you would like to give them? Touch me's or touch me nots? 18th birthday, so I'm giving you a 10-year time frame. You can think through.
I think it will be a mix of both.
Mix of both.
It will be a mix of both. As I said, that it is not about, touch me nots have fallen just off the roof, which is why I see a very compelling opportunity in them immediately. But those touch me which will continue to deliver 20-25% earning growth, which will continue to behave properly, do not distort the balance sheet, will continue to focus on ROE. That clearly be.
But you would not like to single on a single theme. For example, 2003 was singling on stocks like JSPL and Siemens because India was growing. Then you took a big bet in agri. Then you took a big bet in construction. As of now, there is no single theme you are zeroing on.
The single theme is underperformers.
Right
now, single theme is hugely underperformers. And again, mind you, I am saying, Nikunj, please do not take me wrong that I am not recommending these sectors. I am very afraid to recommend any sectors. Again, it comes out of 10 years of hard experience. Sectors do not do well. Companies within those sectors do well. So if you look at, let's say, evolution of IT sector in 99-2000, you have 200 companies in the IT space. And IT sector did very well. All the 200 companies were market cap makers. What happens 10 years down the line? You can count the number of companies which have survived and which are doing well. Similar thing which we'll talk about public sector banks, construction companies, infra companies 5 years and 10 years down the line. That there were these 100 companies, 70, 80 of them have disappeared. But those 10, 20 which will survive, they will do exceedingly well.
So does your list include mid-caps as well, or are you concentrating on the
it is a combination of mid-caps and large caps.
So what are your key assumptions for FY12 when it comes to inflation, rates and the dollar? Because dollar has been the biggest irritant for portfolio investors.
Sure. I think I'm looking at inflation falling to maybe around 7% by March.
This March?
By this March. It is very aggressive, but I'm willing to stick my neck as usual. So I think it should be around that. You should see easing of policy rate by RBI in the first quarter of next year, somewhere near, once this inflation starts to get reflected. The thing which you should watch out for RBI to reverse is when bond yields are significantly higher than the inflation. I think right now the equation is inflation is higher than the bond yields. They will continue to tighten. But when it comes, it turns hopefully the other way around. I think they will start to. So you will have easing of interest rate in the first quarter starting maybe from February or March or April. So that is one assumption which I am sticking to. I think about dollar and rupee, it has surprised me, and trust me, I would not like to hazard a guess in that direction, though I feel rupee in the medium to long term, given India's prospect, has to appreciate. And what is it depreciating against? It is depreciating against currencies or countries wherein there is a bigger question mark than India. So logically it should not, but you can't take a 3-6 month perspective, because this is all about demand and supply. If there is a huge problem in the globe and if you have $5 billion of FI outflow, rupee could underperform, it could go to 52. We don't know.
So given all your assumptions for the month of March, where do you think the index will be by then?
Let's not, pinpoint that number, because as I said, it has no meaning. Trust me, there are so many assumptions, so many events which I think I've spoken enough about the direction of the market. But will I like to pinpoint a number? My gut is that logically by March, April, you should be higher than where you are today, if the international situation doesn't collapse. And again, my underlying assumption is that because the international problem is becoming slowly a political problem, so it is no longer meetings of governors or Federal Reserve maker. It is meeting of politicians, and because it is starting to hurt them. So I feel there will be some resolution which will happen to this international problem, which will postpone this problem. I do not think it can be solved. It can't be solved by anyone, but it will postpone the problem. So I'm hoping some event of that may happen over the next 6 months.
But the 2004 to 2007, Indian markets multiplied almost 3 times. That time we were in this golden scenario. Inflation was low, global liquidity was very high, and the credit growth rate was above 30%. Do you think that golden era for Indian markets is over? We might not get that golden era when stocks multiplied 50 times, 100 times, even 1,000 times.
In fact, Nikunj, this is a very, very good question. This is where I become slightly less bullish than what I have been always, There's something in the world which is changing, which is, all these countries which were running huge current account surpluses because of the slowdown in the world in general. If Denmark is growing 15% negative, if Greece starts to grow 7% negative, it will get reflected somewhere in the consumption, and it will get reflected into numbers of all these countries. So we are generally of the opinion that the global liquidity will be tight in the next decade. Interest rates globally will have to be higher than where they are. So all this cheap money phenomena which was pushing asset prices actually will get challenged. Now will it get challenged in the next 12 months? No. But will that get challenged over the next 5 to 10 years? Yes. So let's say Indian companies, which were borrowing purely at 3.5-4% interest rate, and rupee was appreciating, so cost of money was only 3.5-4% for the entire decade, whole of last 10 years. I think that equation will gradually change.
So the structured bull market is over. Now you have to look at secular businesses which will do well.
Absolutely.
Madhu, last time when I interacted with you on this forum, you said the best for India is yet to come, and you famously said, "Abhi to picture baki hai do."
Yeah.
You think for Indian retail investors, the best is yet to come?
I think so, Nikunj. Again, if you have a medium to long-term perspective, the only problem which I have is Really, preview is getting longer and longer, and they are making us wait more and more for the picture.
The trailer is never ending.
I think the picture will come, and that is why my conviction is, that is why you still see me around these markets. If I was convinced that the picture is over, then I should be doing something else.